from the 1st of September 2024. And this week's was called Back to School. So for those who have tuned in before, you'll know I like to start with a quote. And this week's quote was, "Education is the most powerful weapon which you can use to change the world." And that was from Nelson Mandela, the former president of South Africa, and a quote that I very much identify with and agree with. So before we get started, I just want to give one more plug for the tickets for the next property business workshop in London, Tuesday the 1st of October. And this time around, Rod Turner and myself are covering exits. We've got two main objectives for the day. First of all is about planning your own, which people do very poorly in our experience. And secondly, so you can understand other people's exit plans, perhaps challenge them, perhaps help build them, and assist really when you're looking to buy a portfolio or a business, because so often their lack of exit can get in the way of them doing the deal. So not only can you help the vendor get what they want, need and deserve, you can really work through a true win-win situation where you can both benefit. And as always, it's going to be an action-packed and content-filled day, which will stand alone in helping to advance your understanding as a property business owner. The link is live. There are early bird tickets still available for a couple more weeks. And that's bit.ly/PBWFOUR. Thanks very much and welcome to the supplement proper. We're into the last third of the year now, the third quadrimester, if you prefer. And there's lots to discuss this week, as always. In the deep dive, I'm going to get into a Hamptons report that has been lost in the least quiet summer I've ever had regarding BTL purchases falling to a record low, and a look at some 20 CI analysis, which does a great job at putting some of the data into a proper contextual format. The gear change is slow, to say the least, and in the last few days, we learned that housing starts were down 34% to under 30,000 in the first quarter of this year, with completions in the year to March at 183,610. That 370,000 that Angela Rayner has set must feel like a long way away, but they are indeed starting from a pretty low base. We're going to have a squiz at the ONS report too about housing starts and completions and get into that in a bit more detail. But before any of that, I'm going to press on with the real-time market analysis. I always give kudos to Chris Watkin, who delivers week in, week out on these. I spoke to Chris on Friday night about a technical point. You'll be glad to know that's what I was thinking about with my Friday evening, which was a good, fun conversation, as it always is. He also offers some bonus content too sometimes. And the figures for this week show plenty of listings, still 35,000 across the UK as we gear up for what's usually a busy period, although August has been a bit busier than usual thanks to that interest rate cut. We're still seeing about 7.5% more listings than we were on an average week before the pandemic. Net sales also outperformed, 34% higher than the equivalent week in 2023 and nearly 15% higher than the pre-pandemic market for the same week. So that's how much busier that week of August has been, and you'd have to put that down to the first cut of the interest rate in this cycle being responsible for that, I think anyway. The average listing price was up a couple of percent on last week. I think the market smells blood and knows that September has come, but still new listings were around £407,500 on average, which compares favourably to the average 2024 listing price of nearly £440,000. The market still looks reasonable value, and I'm seeing some retail transactions happen and thinking that's a bit of a bargain really, which I very, very rarely do. I'd say it's a good time to be moving residential property if you're going up the ladder. That's my personal opinion. So before I get into the macro, I just wanted to note the screaming that for October the 30th that is now going on. You can't move for people wanting to exit within the under 2 month timescale after the Grim Reaper, Mr. Starmer, spoke this week in a wrist-cutting soliloquy. All I keep seeing is a mistake about manifesto tax promises getting compounded time and time again. The new rhetoric has shifted to allow taxes on employers to go up now. I think employers' national insurance is in danger, and hospitality and retail will be creaking if that's what goes on. Inheritance tax, capital gains tax, pensions relief, they must be going up or down in the case of pension relief. This really is a bit of a meatloaf moment where 2 out of 3 ain't bad, if that's what the public gets away with. But listen, don't get mad, get even. Capital gains tax, just refuse to sell anything. Inheritance tax, just don't die. Okay, I accept that one's harder. Or marriage someone an awful lot younger, because remember, there's an interspousal allowance. Of course, my tongue is firmly in my cheek when I give those recommendations. Look, you've got to get yourself in shape to perform rapidly and give vendors what they want and they need. We don't have any mottos in my office on the walls, but if there was one, I reflected this week, it would say, never discourage a keen vendor. As always, the fear will be worse than the event itself, but as I write this, a poll I'm running on my LinkedIn has Leave the UK as the most popular option to cope with the tax rises that are coming. I'm sticking with keep calm and carry on, don't worry. So, onto the macro. We had the Distributive Trades Index, the Nationwide House Price Index, the Bank of England Money and Credit Report, including the money supply, and you know that we'll round up with the gilt and swap yields. Distributive trades. A brief reminder, these are produced by the CBI, the Confederation of British Industry, and it's a survey around retail sales volumes. It was another negative print, minus 27, which was an improvement on the horrific July number of minus 43, but still well below consensus expectations. Selling price inflation looks to remain below the long-term average next month, and it's already there, which is one bit of welcome news. Sales were poor for August, and retailers expect to further reduce investment over the next 12 months, as if they could invest any less. Retail employment is contracting for the majority of survey respondents, as it has done for 8 quarters in a row, or 2 years in a row. The principal economist for the CBI, Martin Sartorius, put out a hopeful quote. The sector will want to see measures in the budget this autumn to give certainty to firms and incentivise investment. Reforming business rates, including a business tax roadmap and changing the apprenticeship levy, would help businesses to deliver on the government's ambitions to supercharge the economy. Yeah, I think he probably knows that he's doing his job there, and fair play to him. It's worth a go, but realistically, something's going on towards the wind that's not gonna work out. What will come good from the Iron Chancellor's scythe of a budget? I'll stop calling that soon, probably. Or we'll have 2 months of that. I'm not going to apologise anyway. But let's consider everyone's expectations to have been managed. So, volumes in every retail sector have contracted and are contracting. And thanks for the comment, Shyam. I've seen that. I'll respond to that at the end, if that's okay. Volumes in every retail sector have contracted and are contracting. The business to consumer or the consumer market is a very tough one right now, however you look at it. Especially if you're selling goods. Not so much services, but goods are problematic. There's room for improvement in the future, you'd think. Nationwide next, and how I enjoy their numbers. After finally coming round to the market, 6 months plus after supplement listeners last month, they then saw a 0.2% contraction in August. You might think this is standard for August, but these are seasonally adjusted figures. They led instead with a headline about annual house price growth, as that did improve to 2.4 from 2.1. We won't remind them that back in December they were forecasting another small decline in low single digits or remain broadly flat for the 2024 property market, although I just did remind them of that, of course. They still see prices about 3% below the summer 2022 prices, according to their numbers. There's some interesting data deeper in their report this month, though. They take a look at price premia for energy efficient stock, or reframed, significant price punishment for energy leaky stock. So, A or B rated properties now tend to trade at a 2.8% premium compared to a D rated property, which is still the average in the UK. Around C to E, there's very little difference, and Fs and Gs, which of course you're not allowed to use as rentals, although there's plenty of people that still isn't stopping from what I see on a week to week basis, are trading at a 4.2% discount to a D. So it's a 7% difference there between A's and B's and F's and G's. Now, these numbers have moved a bit since 2019. In those days, the premium was 1.7, not 2.8, and the penalty was 3.5, not 4.2. So the market is slowly waking up, moved from about a 5% differential to a 7% differential. We'd really want to know how much of this happened after the utility pricing changes in the winter of 2022 to really see if that started to shift attitudes and willingness to pay for less leaky properties. Now, if you think like me, you might hear those stats and think, hang on a second, A's and B's tend to be newer build. But Nationwide have thought of that and controlled for it, we are told. We have to take that at face value because this isn't a research paper, this is just a press release at the end of the day. 48% of housing stock is now rated C or higher, which is up from 18% in 2012. Now that should be lauded as an incredible achievement, to be honest. New builds do increase that by about 1% per year alone, if that, maximum. So it isn't just 12 years of new builds making that difference. The average cost to get to a C was £7,400 apparently, with E to G costing £13,500 on average, whereas D to C costing about £6,200. And remember, those are the costs looking backward, not the costs looking forward as we approach 2030. I thought this was interesting and timely, and they've clearly done this to coincide with the reintroduction of the notion of EPC targets for the PRS by 2030. A landlord survey this week revealed that 95% of landlords think this is impossible. And indeed, it will be. Although the rules will be fudged, of course. There are already fudges, listed buildings being one. There will need to be a provision for leasehold, even with reform bills, unless legislators are idiots. There's really quite a limited amount of measures you can take within a flat, certainly in some flats with certain types of freeholders. Now, a monthly favourite of mine, the Bank of England Money and Credit Report. These are July's figures. They're always produced a month in arrears. Most look at the number of mortgages completed, and that's a good gauge of the health of the market. But there's plenty more richness in the data if we dig a little deeper. 62,000 mortgage approvals is the highest print since September 2022, where it was over the magic 65k, which I've always said for the last year or so I've been commentating on these numbers, I'd like to see as the sign of a really healthy market. Remortgages fell back to 25,100, which is fairly low. More typical lately, we've seen the number around 30k. Private companies paid back 3.6 billion of finance net for the month of July, although 2.3 billion was net equity buybacks, which personally I wouldn't necessarily be counting with too much vigour, but of course it is technically finance. It's just not traditional debt finance. The money supply also moved up a little, although the expectations were higher. We're still lower than October 22, when quantitative tightening really started. Some other stuff happened too. I don't talk about it much, but you might remember very thin Lizzie and her rain or shower. It was below consensus, but still up 0.3% month on month. And you know, I always say money tends to find a home, as the monetarists say. Not really looking consistent with 2% inflation quite yet on that front. And as we get deeper into the mortgage stats, we saw an average drawdown rate of 4.81% in July, which wasn't much different from June, but as at today looks expensive, with sort of 3.6 being the best price on the resi market. I'd expect it to be more like a low 4. The average outstanding debt in the stock is now averaging 3.69%, creeping closer to that 4.81, which I think now is going to crater within a couple of months. Credit card borrowing is still growing 10% year on year, but it's still not overly worrying yet, as the sector is still repairing from massive net paybacks during the pandemic. So, a healthy buying month in July 2024 by the looks of it, and many were perhaps waiting to remortgage when they felt the Bank of England might cut rates in August, as indeed they did. I'll be watching this report next month with continued interest. And then the gilts and swaps, our staple of the macro. The 5-year gilt closed Thursday at 3.795 and Friday at 3.816% yield. And the 5-year swap closed Thursday at 3.704. We opened the week at 3.777 on the 5-year, and so it was a tiny up week with little news of consequence based on a short week thanks to the bank holiday. I'd rather down than up, of course, but tiny up is acceptable, of course. 9 basis points of discount between the swap and the gilt looks back to roughly standard times for 2024, which is still leaving our best guess 5-year mortgage money rate for limited companies at about 5.7% or so, or the equivalent after fees are amortised. Great. Hopefully we can trend down on the swaps and gilts next week rather than creeping upwards. So on to the bigger soapbox for this week. And this week, the common theme is about Exodus. No, not the second book of the Bible. It's more than Exodus, actually, because it's also a lack of replacement that should be concerning those at policy-making level. I've often praised the quality of Hampton's research. They're so much more sensible and less dramatic and much more realistic than so many of their rivals I could name. They lead with the headline, buy-to-let purchases fall to record low. So you can see they're not really concentrating on the Exodus side, but the replacement side. They frame what you might expect quite nicely. Tax and regulatory changes since 2016 have been the main culprit. But these disincentives to invest have been compounded more recently by higher interest rates and political uncertainty around the threat of more rental reform. very good. Needs evidence, of course, which they're normally quite good at. Some of that evidence can only be provided by survey. And then how do you survey people who didn't do something with any accuracy? It's not easy, and I'm always suspicious of surveys about intention rather than action. But there are a number of ways that various portals and agencies measure landlord sales and purchases that we can get into. Hamptons are a large organisation, but they are heavier in the south and east, and that does need bearing in mind. They have produced from their own internal figures a graph running from 2010 showing sales versus purchases for landlords. The lines crossed rapidly after the 2015 budget, and this can be no coincidence. So before the 2015 budget, there were many more purchases for landlords than there were sales. Then they crossed over, and the lines have yet to meet again. So, if I give you a rough idea, 16% of homes sold by Hamptons were bought by private landlords in 2015. This dropped to 13% in 2016, and then 12, 11, had a brief resurgence in 2021 and 2022 as people speculated with their stimulus money, their bounce back loans, their COVID, their CBILS loans, and all the rest of it. And eye-wateringly cheap rates in those years, certainly the beginning half of 2022 as well. But now in 2021, H1, the first half, it's cratered to only 10% of all transactions. So that's the all-time low of since they've been keeping the figure since 2010. In the meantime, in 2010, private landlords represented only 4% of all sales. The buy-to-let sector was still really young back then, especially if we measure it by the introduction of the first buy-to-let mortgages in 1996. There are other reference points we could use, of course, but that's when the real explosion in rental started. This hit 16% in 2016 and stayed there, although it's dipped and risen a little since. At only 13% in the first half of 2024, many have obviously not sold. But although I used it as the graph for this week, which you can check out on my LinkedIn or on the Partners in Property website, the links are in the comments or in the show notes here. If you subtract the percentage of sales from the percentage of purchases, you've got a brilliant idea on the direction of travel in the sector. So 2010, the difference was 10%, then 7, 7, 5, 2, 1 in 2015, and then we went -3, -4, -5, -3, -2, -2, -4, and -3. So if I aggregate those together, and we're still at -3 in the first half of 2024, by 2015, 32% more transactions that Hamptons had performed had been purchases of buy-to-lets rather than sales. Since then, 29% have been sales rather than purchases. So nearly really moved back. Now, earlier on in that cycle, the volumes would have been maybe a little bit higher, not 2010, but then we had a hugely high transaction volume in 2021. So it's roughly evened out nearly, and we're looking at getting back to the same sort of volume of rentals as we might have had in a year like 2010, which would be nearly unthinkable. Although if you remember, the rental market had still exploded thanks to the financial crisis because a lot of people couldn't sell, but with the low interest rate they could hold on and they then chose to rent. But listen, the direction of travel is worryingly clear. The English Housing Survey, which you would expect to have superior data, would dispute the clarity of this pattern. However, as I say, when you consider it's likely London or South East heavy, this makes loads of sense. The period of meteoric growth and speculation came to an end in London in 2014, 15, 16, depending on which part we're talking about. And you'd expect investors to have therefore become net sellers, and even more so once the tax changes and the interest rates have kicked in. Hamptons also tell us that in their experience, the investors who have continued to actively buy buy-to-lets this year are mostly cash-rich, larger landlords who are continuing to expand their portfolios. If H2 of the year replicates H1, there would be 113,630 new purchases in Great Britain of buy-to-lets, 75,900 or 40% fewer than in 2015. Regional figures largely bear out my accusation of Hamptons being southeast heavy, but they confidently predict and share figures for all regions. But the real illumination on their regional figures is Scotland. Draconian rent controls have seen investors vote with their feet, with only 1 in 20 or 5% of transactions being for buy-to-let in Scotland. Plus that 6% ADS, as they call it in Scotland, the additional dwelling supplement,